So, what should you do when you see the word guarantee in an offer made to you? Join me, guys. Hi, folks. Welcome to the podcast, The Way I See It, which is my podcast that talks about money, personal finance, the economy, and what we can learn from all these guys. This week, I want to talk about the word guarantee. Very important to me because the most inquiries I get, people send me lots of messages with investments in quote, and they ask me, "Hey, is this real? Can I invest in it?" Because in quote, they are guaranteeing me a return of say 10% every month. What should I do? What's your view on it? So, and I always tell people, hey, I don't think this is a good investment, or this might need more work from you to do more due diligence. But I thought it would be a good idea to just lay out what to look out for when you get all these offers that give you these guarantees, which is what I want to do with this podcast. So the first thing I did is to go look up the word guarantee in the dictionary, the Merriam-Webster dictionary. And guarantee is basically the assurance for the fulfillment of a condition. So a guarantee assures, that's what it is. If somebody guarantees you, he's assuring you that something's going to happen. If we then bring in the guarantee into the financial market or into financial parlance, if I am assuring you of something, I'm assuring you either I'm going to return your principal back to you, or I'm going to guarantee a return back to you. I am going to give you your principal plus a return on that principal back to you. So financial guarantee, more or less, is an assurance of a financial condition. And that condition could be a gain or a protection from principal loss, which is basically we're just saying that when someone gives you a guarantee, they're either guaranteeing that they're going to return or that your principal is going to be safe or that your principal will grow. They'll give you a return. That's one of the two things that they could do. And if you look at the investment field, there are lots of offers all around. You have the guys in agriculture saying, hey, buy bell peppers fund, and we guarantee you, say, for instance, 10% every 6 months. You have the guys doing the currency trading, say, hey, invest in our fund for currency trading, and we give you 10% every month. You guys, the equity guys, you have the cryptocurrency boys. It's just a lot of offers, so a lot of words being used that we want to just distill and understand what they are. Okay, so first of all, let me just say this to summarize or to paint the picture for us. Once someone makes you an offer and guarantees that offer, so someone says, I want you to give me money. And if you give me money, I promise or I guarantee or I assure you I will give you back your principal with a return, maybe 5% or 10%. Once someone makes you that offer or that statement, no matter what he calls it, he's basically giving you a bond or he's asking you to invest in his bond. And a bond is just an IOU. That's just what it is. An IOU. That's basically it. So when the bell pepper guys tell you, hey, invest in bell peppers, we're going to pay you 10% in 6 months from the yield from per hectare, all that is fine and good. But what they're really saying is, we're issuing you a bond. We want you to invest in this bond, and this bond will pay you 10% after 6 months. That's basically what they're saying, which means that when we get those offers, we have to go back to how do we review bonds, and we have to review that offer the same way we would review a bond. That's what we have to do. So what are the key things that we want to look for if we had to buy a bond? That's now the question, really. For us to review those offers from the crypto guys, from the currency guys, from the agricultural guys, from the equity guys, we want to basically say, how can we review bonds? The lessons we learn from reviewing bonds is what we're going to apply to reviewing offers that have the word guarantee, fixed return, all that's terms. That's what we want to review. The first thing we do with a bond is we want to know who the issuer is. That's the most important thing. If a bond is issued by the government, it's usually termed risk-free in quote, because it's the government issuing it. So more or less, the government can, all things, if everything fails, the government could print and give you back your capital, more or less. So it's the bonds issued by the government are backed by the full faith or the full faith and guarantee of the issuing government. So we tend to be called them the risk-free rate or the risk-free instruments, yeah? And everything issued after the government, or if the government issued, say, at 5%, then you see that most corporations or most states or most private sector in firms would issue at 5% plus, because they use the government rates as the risk-free rate. So they are going to be government plus a certain premium because they are termed riskier than the government. So the first thing we want to ask is, who is the issuer? Which then means that if a company, for instance, the largest company in Nigeria is going to be Dangote, right? Dangote Cement. If Dangote Cement issues a commercial paper, which is like a private bond, we will look at that paper with the paper will do better in the market in terms of risk acceptance than if an individual just issued a commercial paper. Why? Because Dangote is much, much bigger. So it's termed that he has much more reserves to pay, more or less. So in terms of the risk rating, you can see that the issuer, in this case, Dangote Cement, would have a better risk rating than the private company. If the government of Nigeria issues a bond, they would have a better risk rating than even Dangote, because people will say, the government owns the oil, they have the full faith and guarantee. So they would then be the risk-free rate. So the first thing, of course, is going to be, who is the issuer of the bond, right? The number two thing is to say, that issuer, is he registered? Is he registered with the Corporate Affairs Commission, i.e., is the company itself registered? Number two, is that offer, that financial promise, is that offer registered with the Securities and Exchange Commission? So the company is the CAC, but to issue marketable securities to the public, the company has got to make sure it has a SEC license, the Securities and Exchange Commission. So number one, we'll talk about who the issuer is. Number two, is that issuer registered to operate as a company and to operate as a seller or creator of marketable securities? We want to make sure that we answer those two questions. Are they registered? Or who is the issuer? And are they registered? And are they registered to actually issue financial instruments? Now, the third thing we want to talk about is now the guarantee that they are making. And the guarantee they are making, we have three sub-questions we want to answer in that guarantee. Number one, how will they pay back that guarantee? So if the ball pepper guy tells us that he's going to pay us 20% in 6 months, how is he going to pay back? Is he going to pay back from the sale of the peppers, and then when he sells, he makes a profit and he pays us? Is that the answer? If that's the answer, what's the process? Where would he sell the peppers? When he gets the cash, where does the cash go? Does the cash go to his operations and then he pays us? Or does the cash go to a sinking fund? So a sinking fund is like an account that he's created specifically to collect money and pay us. So he might not wait for 6 months to pay us. He could set up an account and say, every month I would save certain amount of money into this fund, and this fund is going to pay back the investors in my farm. So that sinking fund is just a separate account dedicated to pay back the investors. So the first thing, of course, we've talked about is, who is the issuer. The number two, is the issuer registered? Is the product registered? Number three, we want to talk about now, is there a system or an account set up to separate the money that are going to use to pay back the investors? Is that sinking fund set up? Yeah. If it's set up, it's good, because it reduces the risk that, hey, at 6 months, they'll start to run around for the money. If they have a fund that they could contribute monies every month, that's good, yeah? So that's the third concept. And like I said, we're going to break down the guarantee into three parts. So the first part of the guarantee is there a sinking fund? The second question is, this sinking fund, who is managing it? Is it managed by the company itself, or is it managed by a third party? We prefer it's managed by a third party, and most times you have what's called trustee companies. There you see First Trustees on the right. This is what they do. You could go there and set up a software sinking fund, and the sinking fund will be managed by the trust company. What this does is it reduces, the chance that the company could say dip into those assets. You know that those funds are separated and segregated only for you. So that gives you a bit more confidence that you're going to get your money back. So the first question we've asked is there a sinking fund? Number two, we've asked who is managing the sinking fund. Is it a company or is it a third party? Now, the third question we want to ask is this: what happens if the company doesn't sell the pepper? How else will they pay us? I.e., are there other assets that are set aside to pay the investors? Is that bond secured by any assets? It could be the pepper, it could be the company head office, it could be a big piece of land in the prime area. So we're asking, is that bond secured? If it's secured, we like it, right? If it's not secured, okay, but we'd like it to be secured. So under guarantee, we're saying number one, we want to see a sinking fund if possible. Number two, we want that sinking fund to be managed by a third party. And number three, we want to see, are there other funds set aside, not under the control of the company, but given to that trustee company or to someone else, a trustee, to manage and to hold. And in the event we don't sell peppers for the year, those assets could be sold and then we could get our funds back. So what we've tried to do is to say, hey, once we see a company giving us, making us an offer, and in that offer we see the word guarantee or promise and all that, we have said that that is an assurance of a condition. That condition could be a preservation of capital, or that condition could be the guarantee, the promise of a return. We've then said, once we see that, that turns that whole language into a bond. We've asked ourselves, how are bonds valuable? How are bonds measured in terms of their risk rating? We've said the first thing is that we won't look at the issuer of the bond, we won't look at if the issuer is registered, and if the issuer is registered to actually issue certificates. Then we came to the guarantee itself, and then we asked ourselves, is there a sinking fund set up? And number two, who is managing that sinking fund? Is it a company or is it an independent independent trustee? Then we then ask ourselves, is there any other or are there any other assets set up by the company to then hold those assets, and in the event the company defaults on its promise to pay us back? We've said we'd like to see that. So you can see, if we have a company that is able to, should we say, meet those demands, meet this criteria, these conditions back to us, it makes it a lot easier for us. It makes it a lot easier to fund or to satisfy that guarantee that has been given to us. And this is what we want to look out for. Because, guys, it is impossible to know the future. Fixed income, variable income, it's impossible to know the future. So the more risk management that we do, the more steps or the more questions that we ask ab initio before we invest, the better it is for us to make sure that we're able to preserve our capital and we're able to get our funds back even after we're invested. Remember, everybody, alcohol makes you drunk, but lots of people drink without getting high. It's the same thing with investing. Gambling itself is not illegal, but you can gamble and not lose money, or you could gamble and know when to pull out. But the important thing is to know that it's gambling, so that you don't pretend and say, oh, I'm not gambling, I'm just investing, and then you basically lose your money because of the guarantee. Once the word guarantee is used, it becomes a bond, and that bond has got to be backed up by physical assets, or by physical transaction, or by physical due diligence setup that you can basically look at and say, yeah, you feel more comfortable giving these guys your funds. All right, guys, so we're going to basically stop here, knowing that we have passed that information across to you guys on what to do when you say the word guarantee on an investment. Just a few things that you want to ask, or a few questions you want to ask. Yeah. Remember, these are not absolute, but these are like should haves, or things we prefer to see before we invest. Okay, so we'll stop here. Follow us on Twitter, FinPlan Kalu Ajo 1. We do share lots of interesting stuff. You would love it. We're also on YouTube, Kalu Ajo. You look for me on YouTube. And we do a webinar almost every 2 weeks in a month now. We have a webinar on Zoom. We would love to have you guys join in there. Keep sending us questions. Keep sharing. We appreciate you all for subscribing and sharing the podcast. You guys have a great day. I will talk to you guys later. Bye.